and so on. But the main part of our review was on the forward-looking analysis. And we also identified a couple of barriers to wider adoption of ERA in the financial industry, because really we found only a small number of very large financial institutions, especially those in OECD countries, and a couple of them in China have adopted this. The majority of financial institutions, I would say more than 90%, are not yet involved. So there are a lot of problems, a lot of barriers for them to adopt ERA. And against these barriers, we proposed a couple of options to promote the wider adoption of environmental risk analysis. The barriers we identified are the following. One is a lack of awareness of environmental risks, which has to do with the lack of supervisory guidance, and of course, the lack of understanding of the concept and seriousness of such environmental and climate risks within the financial institutions, and also has to do with inadequate data, lack of capacity on methodology. And for emerging market, there are specific issues which I can address a little bit later. And finally, the methodology themselves may not be advanced enough to be applied to particular areas. And against these options, we proposed, against these barriers, we proposed a couple of options to mainstream environmental risk analysis. One is on enhancing the awareness, which require a lot of attention by the regulator, especially guidance from the regulators, and also internal work of the regulators. For example, if the central bank or banking regulator begin to conduct environmental and climate risk analysis, it will send a very strong signal to the regulated entity that they have to follow, because the seriousness of these risks, especially in terms of financial stability implication, are being recognized by the regulators. And the second thing is on the collective efforts for developing more analytical capacities and sharing data and making data more available. Also, some demonstration projects could be organized either by regulators or universities or international organizations, and better disclosure of environmental related data, including the financial institutions' exposure to environmental climate risks and the results, are important and may be becoming a very important incentive for them to conduct such analysis. And also, we think some more consistent key risk indicators need to be developed and agreed at the international level, so that all the financial institutions will have a few particular indicators to look at and compare the risk levels. And finally, we need some sort of taxonomy to really define green and brown in order for the financial institutions to measure the exposure, especially to the brown side of the assets. The occasional paper is a companion report, which is much longer than the overview. Overview is like 60 pages. The occasional paper mainly look at the technical methodologies, and it's written by more than 30 organizations. I am the chief editor of this volume. We have covered most of the currently used methodologies by banks, asset managers, insurance companies, and covered various kinds of physical risks and the transition risks. And finally, we discussed some of the methodology issues, including assumptions, including data, and including the weakness of such methodologies that do not necessarily provide feedback loop between the micro level analysis on financial risk and the macro feedback. Now, some of you may be wondering what exactly are we talking about in terms of such methodology. Let me just give you a little bit details in one of these chapters, which is developed by my team at Tsinghua University, looking at the impact of energy transition on a bank's asset quality, namely to what extent the transition of the energy sector, especially in the coal-related sector, may lead to more NPLs within a bank or within the banking system. Now, here is the structure or framework of the different modules of the methodology. We started by setting the climate scenario, for example, 1.5 degree, 2 degree, 3 degree, and in each scenarios, there are different transition policies applied to the energy sector. And secondly, we looked at under various scenarios, what kind of transition impact on macro and sectorial variables, such as on economic growth, on sector demand, for example, coal-related demand or coal-fired power generation. And thirdly, applying such sectorial impacts into the company level analysis by looking at the impact on company financials in terms of top line, bottom line. So we used these inputs to estimate the future change of revenue, of cost, of profit, of all kind of ratios on the balance sheet. And finally, putting all these financials into a default model, probability default model, PD model, to estimate the impact of the energy transition on a particular loan that's extended to, for example, a coal-fired power generator. We have done some case studies, especially on the coal-fired power generation sector in China, and we considered 5 transition factors on the typical coal-fired power generation companies. One is demand drop. Because of any transition, demand for coal-fired power generation will decline and demand for renewable energy will go up. So it implies a decline in revenue for the coal-fired power generator. And secondly, because of technology change, renewable energy such as wind and solar will become much cheaper. And within 10 years, we estimated that these renewable energies would be only half of a price compared with coal-fired power generation. Therefore, it will putting downward pressure on thermal power company in terms of pricing power. And thirdly, carbon price will likely to go up significantly. According to the World Bank forecast, it may go up by 10 times within 10 years as part of the transition towards carbon neutrality. And therefore, those thermal power companies which are not reducing carbon aggressively will have to pay for higher carbon prices as they are being covered by the carbon market in China. And so, fourthly, because of the deterioration in financials due to the first 3 reasons, the funding cost for these companies will go up as the internal credit rating, for example, within the banks will go down because of the first 3 reasons I just mentioned. And therefore, the interest rates or funding cost for the company will go up. And finally, as some of the banks in China are already considering, and in fact, the regulators are considering as well, an increasing risk weights for brown assets, which may include coal-related assets, that implies that the regulatory change could also increase the funding cost for these companies. So given these 5 assumptions, we put the financial ratio increase or decrease into the PD model, which ended up with these forecasts on PD, probability of default, for 3 representative thermal power companies in China. And just to conclude, if we consider all these shocks, which I mentioned earlier, 5 shocks together, within the next 10 years, these 3 representative companies will see their probability of default rising from about 3% today to more than 22% within 10 years. Note that this 22% is about the annual default probability, not the cumulative default probability. So very, very significant impact on asset quality for banks, especially those with high carbon exposures. There are many other case studies in the occasional paper. I can only show you just a few pictures and illustrate it with results. For example, there's one methodology which is done by Professor Battison, uses a climate value at risk, looking at the risks for European banks as they are exposed, some of them are exposed to high carbon assets. And the other case studies are looking at listed companies under MSCI and measuring the potential change in valuation of these companies. Sorry, somehow my screen disappeared. Let me try it once again. Okay, it's back. Looking at the stocks in various sectors, you can see the result is that in energy sector, the average decline of valuation could be as big as 30-something%. That certainly includes coal and oil and something else due to transition-related risks. And one more case study looking at the changing one-year probability of default of bonds for power-related sector, especially coal-related sector. It shows that the increase in default probability could be several-fold. And there are also methodologies looking at physical risks. For example, climate change induced typhoon or hurricane or tornadoes, and the various modules being developed in some of our case studies, looking at initially stochastic event module, then measuring the hazard and vulnerability, and finally inputting these results into financial modules, which will translate into either default implication or valuation implication for financial assets. And the Cambridge University Institute has looked into impact for insurance, and they're able to measure under various climate scenarios the increase of potential losses for insurance company by 2060. And this is a breakdown of the sources of physical risks for financial assets, and include macroeconomic impact on production, and impact on physical damage and business disruption. And they looked at the various scenarios in the different degrees. Of course, scenario analysis and the stress testing, which I just mentioned, are a major part of our, the reports, but we also covered a couple of other methodologies, including ESG, which is relatively less forward-looking, and also some other methodologies covering water-related risk, which is not considered as directly related to climate. And a couple of other methodologies looking at pollution. For example, the ICBC report shows that the increase of government levies on pollutants, air pollutants, could also lead to increased financial risks for a particular bank. So these are just a very quick overview of a few examples in the occasional paper, and there are many, many others which could be useful to your analysis. To conclude, I would like to say that historically, there are many, many reasons why climate and environmental risks are not fully priced in by financial institutions, because they are externalities. And the current system, including fiscal system, pricing system, the environmental regulatory system, are not correcting the externality fully. And therefore, we need to do many other things to internalize these externalities by financial institutions in order to guide them to put money in the right space, namely more into the green and low carbon sectors. And environmental risk analysis is one of these tools that can help financial institutions to reveal the future externality and the impact of these externalities on themselves in the form of financial risks, and thereby helping them to internalize such externality by developing the capability of analysis and based on that, managing such risks. Let me stop here and be happy to take some questions.
Thank you. Thanks, Dr. Ma, for your great presentation, including the introduction of the NGF case study, as well as some approach from Tsinghua University and other organizations for this environmental risk assessment. We are connecting questions, so feel free to leave your questions in the chatting room. And maybe I can start with the first question that someone asked, what are the major differences of this framework? I think maybe it's the environmental risk assessment framework, its application, the difference between developed country and developing country when we apply this methodology in these two different countries.
Now, one of the key differences is the focus of the risk sources are quite different. For example, back 5 years ago, when Chinese financial institutions began to conduct environmental risk analysis, they first applied such methodology on air pollution. That was a case done by ICBC back in 2015. It was under my guidance. And most of OECD countries, especially Europe and the UK, they began conducting such analysis on climate-related issues, simply because different countries at different stage of development, their immediate priorities are quite different, right? Globally, 12 million people die of pollution prematurely. And most of these premature deaths are in developing countries. I think 90-something%. And therefore, such pollution-related issues tend to be more important or viewed as more important by developing countries. And their analysis could focus on pollution-related issues and maybe on biodiversity-related issues. Because a lot of Central Asian country, African country, and some of the Southeast Asian countries are facing serious problem of biodiversity loss, deforestation, desertification, and so on and so forth. And they will potentially have impact on the living environment, on production continuity, and on financial stability. But of course, climate change is a global thing. Every country will have to eventually look at the impact of climate change on the financial system themselves. And in China, we're beginning to see this shift. Back 5 years ago, we looked at pollution mainly, and now more and more institutions, including banks, insurance company, asset manager, began to look at climate risk as a major source of risk.
You finished?
Yes.
Okay, great. Thanks. The second question and the third question, I think probably we can combine because it's about carbon pricing, how we price the carbon cost. Question two is, would you think central bank can do what central bank can do on pricing carbon in financial system? Whether carbon trading market or other policy instrument can help. And the third question, it's also connected to this. Can you give us some views on the implementation of the national carbon trading market?
Well, the carbon price is supposed to be a result of the quota set by the government on companies that are covered by the market. So if the quota is set at a more stringent level, the carbon price will go up. Of course, how much the quota should be reduced depends on the country's aggressiveness and willingness to implement Paris Agreement. So a lot of countries are changing their promises recently. For example, China, Japan, Korea recently announced carbon neutrality targets, which will drastically increase the tightness of the carbon market if they have one. And therefore, the forecast increase of carbon price in the coming 10 years, I think definitely will be higher than just a few months ago. And in terms of Chinese carbon market, we have 7 regional markets which are operating. And the national market will be up and running at the end of this year. Within a few years, I think the China carbon market will cover about 50% of total carbon emission and will probably become the largest carbon markets in the world.
Okay, thank you. Thanks, Dr. Ma. I think we can finish this section, and thanks for your time. If there are any other question, then I can send it to you by email.
Thank you.
Thank you. Then we can follow by our second speaker, Ms. Yuan Wei, Asia Coordinator from SBN and also from IFC, ESG. So she will introduce environmental and social risk management, ESRM, in banking sector. Wei, are you ready to share your screen?
Yes, Pei-Yuan. Just give me a minute so I can share my screen.
Yeah, my colleagues will help. So please do share your screen. And also, remind to, I'm seeing it. Yes, it's ready. Yes, just to remind all the participants, particularly for those who just register, who just log in, that when you listen to the speaker's presentation, we will have 3 presentations ongoing. And then after 3 speech, we will have around 25 minutes Q&A. So please leave your question in the chatting room or send it to us by email. We will connect all these questions and come back to you after the 3 presentation. All right, so the floor is yours.
Thank you, Pei-Yuan. And also, again, congratulations. I think for those of you who doesn't know that China CIF started as a very small event, like 7-8 years ago, right, in China, as the only ESG investment forum. But now, I mean, over the past 8 years, this is in response to market development. The forum has really grown quite large. And from IFC's perspective and ISBN team, we're also excited to be able to host a small webinar, I think started 2 years ago with a bit of a regional focus, and to share some of the international experience and best practices with the region. Can you see my slides? I wonder if you see the first slide or the actual.
We see the cover page.
Oh, I see. Let me see if how I can move this. Just a minute. Oh, okay. Can you see it now?
Yes.
Okay. Yeah. I will be speaking really on, I think Dr. Ma's presentation really, as he mentioned, is focused on climate risk and is more forward-looking. And what I'm going to introduce here is something the banking industry has been doing, and particularly active in the region. It's more focused, if you would say, relatively short-term or mid-term environmental and social risk management for the banking industry. But even for this approach, it has taken, I think, the emerging market banking industry some time to be here. So we should be fairly proud. I mean, from ISBN, IFC has been fairly proud to be able to supporting a lot of the regulators and banking associations in the region to be here. Here, this is a list of the regulatory banking guidelines on environmental and social risk management, not just from our region in Asia, but also from Latin America. And I think, yeah, this is only China, Asia and Latin America. Again, to emphasize, these are only for banking regulatory banking guidelines on environmental social risk management. A lot of regulators also, central banks also issue other guidance, for example, on green bond. But my presentation today is really only focused on this very niche aspect of environmental and social risk management. You can see a list of, on the top, I'm not going through the list here, but you see these are all by central banks or banking regulators or financial market regulators. Very impressive. And in addition to that, the banking associations in different emerging markets have been very active in developing voluntary guidance or principles for the banking industry to follow. They're of the same nature in content, but kind of a different from a regulatory versus a voluntary industry best practice. If I can move to the next slide. So can you see it? Oh. Somehow. I'm not sure if you can see it. It seems like I got stuck on this page, but I'll just.
Maybe you can quit the full screen model, screen mode, and then maybe you can find easier to control PowerPoint.
Yeah. Is this better? Oh.
No.
No. Okay. Yeah. Okay. I'll just continue, I guess. But yeah, there are some slides I'd like to show. Hope it will work out soon. But what's in those banking guidelines? Essentially, we're seeing two levels, but it lays really a solid foundation for moving into next phase. For example, climate risk management. A key component we've seen, or common components across all those regulatory banking guidelines, is requirement for the commercial banks to have an environmental and social management system in place. So basically laying the foundation on organizational setup, capacity of the commercial banks, so they can have the procedure update, they can have a bit of a process re-engineering to integrate environmental and social risk management into the credit decision-making process. I think that's a remarkable step because, I mean, environmental and social risk management are not inherently part of the banking business like 10 years ago, especially not in emerging markets. But through the regulators' push, a lot of the banks are gradually moving towards that direction, having organizational setup, having accountability system, having process re-engineering. So they started to do a risk-adjusted analysis, taking environmental and social risk considerations into consideration, factors into consideration. This is a major change, a behavior change. It can be a slow change, as we have seen in a lot of countries. The regulators are taking a paced approach. I think a lot of the regulators, some of those regulators are on today's webinar, and some of the regulators haven't started this process. You may have a lot of questions, but what we have seen is once the regulator sends this signal, it takes some time for banks to get comfortable with this, get ready for this, to do capacity building, but slowly they're moving towards that direction. And then more sophistication will be introduced into the process. In some of those countries, in addition to the requirement for a management system on environmental social risk, central banks are also introducing sector-level risk management guidelines as a guidance note for banks, as a tool to support banks to do so. So that's a kind of a two-level approach. And then I want to move really into the best practices by commercial banks. So it's a pity that I can't navigate the system here, but what we have seen at commercial banks level, once the regulators send this strong signal, commercial banks are moving. First, they're starting to develop an environmental social management system. And now gradually, once the system is in place, they're also moving into more sophistication, more nuanced approach to manage environmental and social risk at the transaction and portfolio level. There's an interesting case I want to show. Let me see if I can share this. No. Which is a bank we had recently supported to adopt the Equator Principle in China. This is a mid-sized bank in China. What the bank did remarkably is they, on top of having the ESMS system in place, so in addition to comply with the regulators' requirement to have a management system approach, to have an additional ENS indicators into the credit decision making, they also piloted IT system integration, which is quite exciting. And also we've seen larger banks do so. ICBC started to do this a couple of years ago, but that's ICBC, they have lots of internal resources. But this is a case where a mid-sized bank with the support of an external kind of IT firm. So the IFC team basically sit side by side with the IT firm. So we make sure the whole thing is integrated into the bank's IT platform. Unfortunately, I can't show that slide, but there is actually a.
Stop this one and do it again.
Okay, let me see if I. Oh, can you see it?
No, not yet.
Can you see this one?
Yes.
Okay. Yeah, it's all in Chinese, but I think it's really exciting. I think for regulators, it will be interesting to know. This is a screenshot of the bank's kind of IT system. So the red circle here is now you can see this is the traditional kind of a banking platform where you have the basic client information, the project information, security information. But now what the bank has done is they're adding, this is for assessment for the client relationship manager, they're adding a categorization label for environmental risk. So here, they've introduced the ABC kind of, if you're familiar with the IFC performance standards, based on environmental risk, projects are categorized as high risk, medium risk, and low risk, A, B, C, the three categories. So here, where they're marking, there is a environmental risk categorization into the IT system. The relationship manager needs to fill in this space. There's additional information required. The system is also connected with the external environmental database. So basically they can pull environmental compliance information from that database for any borrower they're assessing, using additional information for their decision making. And then they need to categorize the transaction based on this information. This one is categorized as B+, which is relatively higher risk. So once it's integrated into the bank's IT system, there's no way you can skip it. I mean, the environmental risk management is requirement no longer just stays as a requirement by regulator on the paper, is really into bank's IT system, into the credit decision making. I mean, just one thing to mention, in addition to this environmental risk categorization assessment IT platform, this platform also allows the green labeling, green tagging. So you can also label the green assets based on the climate finance category. So allows you to track both kind of levels of information. I think this is quite exciting in the sense of, just to summarize, what we've consistently see from IFC's experience is this first regulators starts requirement for ESMS, basic requirement, and things are gradually changed. Banks are changing their behavior. So regulators are moving forward with additional support. They're developing additional tools. And maybe, I mean, in the future, also climate risk. I see questions asking about that, but that once you have a ESMS, it's possible to add in additional tools, additional subject issues. And then at commercial bank level, we're seeing this positive also progress where banks first start to have a basic ESMS, and then sophistication is further introduced into the process. You see this IT system integration enabling more sophisticated and nuanced risk-adjusted analysis. So I'll summarize, just end here, and happy to answer any questions towards the end of the session. Thank you.
Thanks, Wei from IFC, and as I said, that we will finish all three presentations, and then we will have some more time for Q&A after that. And I think Wei's presentation gives us a very interesting and clear path for regulators and for commercial bank in developing countries, how to move step by step. So thanks. And next, we will move to our next speaker, Anthony Miller, coordinator of UN Sustainable Stock Exchange Initiative. And I also want to take this opportunity to thank Anthony and Sustainable Stock Exchange for co-hosting our China Safe Annual Conference as well for another year. So Anthony, the floor is yours, and you're going to talk about the latest development on climate reporting from the stock exchange perspective. Thank you. Please unmute.
Yeah. We are, I think, 12 months into this crisis, and we still have problems unmuting our microphone. You'd think we get used to it now. Thank you very much, Pei Wan, and of course it's a great honor and privilege for the SSE to be working with China SIF again on this annual conference. And just to echo Wei's words earlier, that it is impressive to see the growth of China SIF that you spearheaded many years ago and has now grown up into such an important annual event, both in China and beyond. So I'm happy to be with everyone today. I'm just going to be speaking very briefly about the role of stock exchanges in the area of climate disclosure and some of the work we've been doing more recently on this topic. Of course, the background to all of this are the UN Sustainable Development Goals, and particularly the Paris Agreement around climate change. We are all focused on climate action, but of course it touches on a number of other goals related to clean energy, to disclosure and transparency of companies, and so on. So with that context in mind, this the popularity of the Sustainable Development Goals worldwide, both in the private sector and the public sector, has been enormous, and it is really shifting the policy environment. And the shift in policy you can see across the board, and it's also being felt in the world of stock exchanges. If we look at the trends and sustainability activities of stock exchanges around the world, you'll see that their engagement in the marketplace, whether it's with guidance on ESG disclosure or training activities or the introduction of specialized sustainability bond segments or ESG equity indexes, you see a tremendous rise over the last few years, particularly in the last 5 years, where you see a lot of these trend lines starting to go vertical. So this is a very heartening sign, but I think this is indicative. If you are doing a deep dive on just about any sector right now, there is a keen awareness of sustainability. And if you look back 20 years ago, where many of these lines are pretty close to zero or at zero, you'll see the real distance we've come. I think, Pei Wan, you and I first met back in 2004 in Geneva. So, you know, think about how things have changed over that time period. A tremendous change. And as we look forward to the next decade, what we often refer to in the UN as the decade of delivery for the UN Sustainable Development Goals, we have to imagine that these trends will accelerate even further. And that, I think, is something key for people to be aware of. And they will increasingly affect the materiality of companies in many ways that we've already heard today from Dr. Ma, and they will penetrate more and more sectors of the economy. So we're really looking at a very disruptive period in industry, and there will be winners and losers. There will be material consequences. There will be risks to address. Stock exchanges are increasingly aware of this, and they're taking these kind of actions to engage in the marketplace. Last time I spoke at the China SIF, I spoke about our Green Finance Action Plan, which we launched at COP21 some years ago. And we are, one key aspect of that, of course, is written guidance. And that's what we're talking about today, about strengthening the environmental disclosure and climate disclosure. And so I want to go into that specific area a little bit. Let me start by looking at the broad base of ESG disclosure. In 2015, the Sustainable Stock Exchange Initiative launched its model guidance for stock exchanges on ESG disclosure. And we started with a very simple observation that in 2015, there were only about 14 exchanges in the world that had written guidance on ESG disclosure. Today, that number is 56. We launched a global campaign. We challenged exchanges to introduce guidance, and the exchange community really responded very favorably. They recognized the need for this. And so now you'll see that virtually every major exchange in the world has written guidance on ESG disclosure in their marketplace. What we've also seen in recent years is a large jump up in the number of exchanges that have mandatory ESG disclosure listing requirements. Now, these are coming either from the exchange or the security market regulator. In many cases, exchanges don't have any control of their listing rules. It's controlled by their regulator. So a lot of these rules do originate from regulators. In some cases, exchanges do have devolved regulatory authority, and so they themselves are implementing these rules. So there is a clear trend line here. So for issuers, for companies that are not yet preparing sustainability reports, and particularly climate reports, they need to really focus on this, because it has been clearly established as a mainstream market expectation by stock exchanges all around the world. And this is a leading indicator of what we will expect later on from regulators, security market regulators or others, around sustainability reporting. Of course, the UN Sustainable Development Goal 12.6 relates to integrating sustainability reporting in all of the annual corporate reporting of large companies. On the current trajectory we're on now, the objective to achieve this goal by 2030 looks very realistic. So again, companies that are not already producing sustainability reports in this space have to be aware that by 2030, based on current trends, it's very likely that this type of reporting will not only be a mainstream market expectation of both exchanges and investors, but will also become a regulatory requirement in your jurisdiction. So it's good to get ahead of this curve and begin working on this now. As many practitioners in this space already know, it is a journey. It's not something that you do well at the beginning. You have to keep working at it, and it evolves over time. And of course, standards also evolve over time. I want to talk a little bit about the standards in this space. When I talk about these 56 exchanges that have guidance on sustainability reporting, we provide some analysis of what standards they're referring to. So 95% of these guidance documents are referring to GRI, for example. You can see the other standards they're referring to here with the percentages of indicators. I've just highlighted these three here in green that are specifically, explicitly focused on climate. So you have more than half of these guidance documents are already making reference to the TCFD, the Task Force on Climate-Related Financial Disclosures that came out. And this is really emerging as a universal benchmark that people are rallying behind. With that in mind, the UNSSE, last July, we announced a new work program on climate disclosure. We were called on by Mark Carney, the UN Special Envoy on Climate Action and Finance, to deliver a new guidance to stock exchanges on how to promote the adoption and implementation of these TCFD recommendations. Of course, all the leading stock exchanges in China have joined this advisory group, as well as stock exchanges, investors, and security market regulators from around the world. I think we currently have about 80 members of this advisory group from about 50 organizations from about 25 different countries. So it's a large international effort. And this is still a work in progress. We're only about a third of the way through, and we will launch this new guidance. We're aiming to launch it sometime in June of next year, and then we'll be taking it right into COP26, which will be in November of next year. So there is still opportunity to participate in this process if anybody on the call is interested. including some of the central banks who may be interested in monitoring this type of work. Just to give you kind of a sneak peek at what we're doing, and this is all still draft in draft form, but we're looking at a number of elements here. So it's reporting, but reporting takes place in this context. Sorry, there we go. Takes place in a specific context. So I'd like to particularly emphasize this issue of risk that we've been talking about today. Ma-Jun highlighted a number of really key material risks, and he was focused in particular on the energy sector, which of course is going to take a very big hit, some elements of that, as new forms, zero emission forms of energy become more and more economical. There's a lot of work done by Bloomberg New Energy Finance in this space that's really fascinating, and that we see the disruptive impacts of these new forms of energy that become cheaper and cheaper every year, that will disrupt and eliminate some of these older industries. This is, if I can use the phrase, a Kodak moment for some of these industries. If we remember the old film company Kodak that famously went bankrupt at the end of the 1990s as they were disrupted by digital photography, we have to think about what's happening before us right now in terms of disruption. And it's not only in the energy space, it's in a number of other industries. We're seeing this in the automobile space right now. Of course, China is one of the leaders in promoting electric vehicles, and this is going to be hugely disruptive for many of the legacy automobile makers as they try to transition to new technologies that are not necessarily within their core competence. And we have to think how that ripples down the entire supply chain, where you've got people making components for combustion engines when combustion engines no longer exist in the future. What does that look like? Again, imagine yourself as a company that manufactures photographic film in 1995. What do you look like in 2005 after everyone has a digital camera? So that is the type of transition we're looking at. And it's the type of timeframes we're looking at too over this decade of delivery. Between 2020 and 2030, we're going to see a rapid transformation of industry around the world. And the key cutting theme of that is going to be sustainability. So is that business fit for purpose in the 21st century? And if the answer is no, that's going to have a material negative impact on the finances of that company. And so investors need to be aware of that. If I can zoom out just for a minute on the issue of risk. So this is also risk at the individual company level, but it's also risk at the market level. And this is something that we're having a conversation with exchanges. For a stock exchange, all of the issuers they have on the exchange, it's almost like a portfolio for an investor. That is the health and the life of the exchange. And in some markets, it can be relatively non-diverse. Some markets can be relatively concentrated in certain sectors. I had a phone call recently with an exchange that operates in a market where most of the largest listed companies in that market are in the fossil fuel industry or the extractives industry. And the other half of the market, where the other largest issuers, are all in the banking industry. But the key thing here is that all those largest banks in that country are all invested in the fossil fuel companies and mining companies of that country. So the entire market is interlinked, and the entire market is standing on the backs of the extractive industry. So if the extractive industry goes down in any way, it takes the banks with them. So this is a key element of systemic risk that I think is the focus of a lot of central bankers at the moment, and I think for very good reason. And it's something that we're also in discussions with a number of exchanges. So I just wanted to go back to the issue of reporting and what stock exchanges are doing on that. There we are. So a key aspect of this is not simply releasing guidance and creating standards. There is a lot of work in that space, and that's critically important. But once you create the standard, there has to be constant, ongoing education and capacity building to ensure that these standards are properly implemented. as well as recognizing that standards evolve over time. Large listed companies have been producing public financial reports since the 1930s, and yet financial accounting and reporting remains a very fluid topic that's constantly the subject of new innovation. So this is an area that we also work with exchanges around the world. I think my slides are probably, oh, there we go. And we partner with a number of organizations, Waves organization, the IFC. We just did a training exercise with the IFC virtually in Indonesia just the other day, but targeting all of the East Asia and Pacific area. We have a strategic partnership with the IFC where we do a lot of training. Stock exchanges themselves are very active in the space. As you can see, just in the last 10 years, you have a nearly vertical trend line going on. All stock exchanges have a market mandate to do education. Typically, or historically, this has always been focused on traditional business issues around accounting, legal compliance, and so on. But in the last 10 years, we've seen a skyrocketing interest in sustainable finance, in climate-related finance and disclosure, and exchanges have really geared up their activities in this space. I think it's a key aspect of this broader picture of disclosure and understanding the risk. A lot of this training is focused not only on issuers about how to prepare reports, it's also focused on asset managers and analysts on how to understand these reports. And I think that comes key to this topic about risk and understanding this risk in the marketplace. So, Pei Wan, I'm just going to end there with just a few takeaway messages that we are working in a new policy environment, which can be defined by the broad strokes of the Sustainable Development Goals, which really shape our thinking and the policymakers' thinking and much of the private sector's thinking. And this is really going to have its biggest impact in 2030, between now and 2030, over this next decade of delivery. So with disclosure specifically, it has already become a broad-based expectation in the marketplace, a mainstream expectation. By 2030, it's likely to be mandatory based on current trend lines. So companies, issuers should be ready for that. And I want to emphasize in particular climate disclosure. So we've recently heard the announcement that the IFRS Foundation, the leading creator of the world's most used financial reporting guidelines, is now thinking about creating a sustainability standards board, and their number one priority is climate disclosure. So the number one priority of many regulators is climate disclosure because they see the potential for systemic risk of the kind that we've been talking about on the call today. So that is a key thing, key priority in particular for issuers to jump on. And for all of those active in the space, training programs are critically important. If we, again, look at the parallel to the financial reporting world, it is a world of constant learning and adaptation. So I'll end there, and thank you very much again, Pei Wan, for organizing such an excellent event.
Thank you. Thanks, Anthony. I am quite impressed at your point that the climate risk is not just individual company risk, it's also a systematic risk for the capital market. And I think the same thing also happen in the banking and credit market as well. And I think this is why the central bank are now thinking about how to handle this risk. Thanks, Anthony. And our last speaker actually will use a slightly different approach to look at the impact perspective. So the first three speakers focus a lot on risk management. And now Yuki from UNEP FI, she's going to introduce the PRB principle for responsible banking, but with a particular focus on impact. So her presentation is from ESG risk management to impact creation. And just to remind all of you that after Yuki's presentation, we will have probably 20 minutes for Q&A. So leave your question in the chatting room if you have any. Thank you. Yuki, now the floor is yours.
Okay, thank you, Pei Wan, and thanks very much for hosting this webinar. Congratulations to China SIF on a very busy, successful week. And thanks to IFC Wei and Anthony at Sustainable Stock Exchange for the opportunity for me to present the principles for responsible banking and, as introduced, talk about impact creation and management. So let me just a quick introduction of UNEP Finance Initiative. The UNEP Finance Initiative is a partnership between United Nations and financial institutions around the world. We have 355 members, mainly in banking, and quite a large presence in Asia. Now, so Wei had been talking about environmental risk management. This has been the real founding block of what defines sustainable finance. On top of that, as Dr. Majum was saying, we now are looking at risk, taking into account not just historical trends, but also the scientific information about what happens if we do not achieve the Paris Climate Agreement and how that might become a financial risk for the economy and the financial system and the individual financial institutions involved. Now, another part of sustainable finance, which has been growing, is around the green financing or the opportunity side. When we think about that, there's a lot of things that you might think about, like the EU green taxonomy or the China green catalog. What those green opportunities are, in one way, it is about the financial institutions trying to respond to the societal needs to achieve the United Nations Sustainable Development Goals or the Paris Agreement. So what we call this as alignment, we are actually seeing a lot of companies, not just in the finance sector, but globally, that are trying to become more aligned to these national development plans or societal goals, and that they are trying to achieve positive impact through their financing activities. Now, in Asia and globally, we are seeing a growth of regulatory demand on banks to contribute to society. And right now, a lot of the wordings are still relatively vague. For example, the Bankers Association Sustainable Banking Guidelines recognizes that the central bank recognizes the role of the financial sector in driving Thailand's sustainable growth. And the Central Bank of the Philippines says that it recognizes the critical role of the finance industry in pursuing sustainable and resilient growth by enabling environmental and socially responsible business decisions consistent with the national development plans, meaning that the central bank expects the banks to support the clients in becoming green and sustainable, and that through their financing products and services, that they are contributing to society. And Bank Negara Malaysia's implementation guide for value-based intermediation specifically says that the banks need to generate positive and sustainable impact to the economy, community, and environment. So and from the investor's point of view, this is also something that we are seeing. So Danone, and the French dairy company, recently concluded its annual general meeting, where they put a resolution saying that Danone will become a company that is accountable to all stakeholders, not just the shareholders or its immediate clients and employees, but that it will be accountable to people and the planet generally. And this resolution was supported by 99% of the shareholders. And in the US, the Business Roundtable, which is an association of CEOs of American corporations, recently redefined their definition of the purpose of corporation. This has been fixed for the last 60 years or so. And it had, the old definition was around the shareholders being the first people that corporations were accountable. But this has changed in 2019 to say that American corporations are the raison d'etre of corporations is that it serves all Americans. So when we say that, so at the backdrop of these changes, an expectation that banks need to not only be responsible for its employees, responsible for its own immediate risks, but that it needs to look further at its influence through its financial products and services. The UNFFI banks developed a voluntary set of principles called the Principles for Responsible Banking. And this was launched in September 2019, together with the UN Secretary General Antonio Guterres at the UN headquarters in New York. So at the launch, we had 120 signatories. And 1 year on, we have 199 signatories collectively worth $53 trillion. And that is worth about 40% of the banking industry's assets and serving 1.6 billion people around the world. So it is becoming quite a standard for international standard for what is sustainable banking. And what it is it is a comprehensive global framework that tries to define sustainable banking in the following way. Basically, alignment that I was talking to earlier, and how that alignment is concretely measured and defined is through impact management and target setting. So I'll just quickly talk about the alignment first, but it is along what I've been talking about, which is the alignment. The banks commit to aligning their business strategy to be consistent with societal goals such as Sustainable Development Goals and the Paris Climate Agreement. And that these principles are committed by the CEOs of the banks. But then how do you actually know whether the bank is aligned to societal goals? And this is where the concept of impact and impact creation, impact management comes in. So we have in principle to talk about increasing your positive impact and reducing your negative impact, as well as managing your own credit risk. So taking Wei's explanation about environmental and social risk management, under the Principles for Responsible Banking, a lot of the banks have changed that to talk about environmental and social management system that would manage not only risk, but also the positive and negative impacts that are created by the products and services individually at the client level, but also at the portfolio level of the loans. And that these will be managed through target setting that will help them to make sure that they are improving on their impacts. So for example, at the individual level, this is an example from one of our members who have been engaging very deeply with their client to create positive impact and reducing negative impact around CO2 emission and water savings and resource savings in general. At the portfolio level, Barclays is one of the first banks who've issued their first Principles for Responsible Banking report recently, and they have been announcing publicly that they will aim to bring their loan portfolio to net zero CO2 emission by 2050 in alignment to the Paris Climate Agreement. So they have created a long-term visionary target similar to what the countries such as China or Japan or the EU and the UK have put. So they have tried to align to the UK government's target on the Paris Climate Agreement. And just to give you some other examples of targets, and I will go very quickly on this one, is there is a lot of working groups that the Principles for Responsible Banking is currently running and around target setting. And one of them is financial inclusion subgroup. So here we are trying to standardize how financial inclusion could be measured in terms of positive and negative impacts, and what kind of targets could be set so that the KPIs are comparable and standardized by different banks in the PRB. So first of all, we've set the framework, and now we are currently, then we need to compare that with the country's needs and then set the bank's own baseline, and then they will be setting the KPIs. So just to give an example, this framework for financial inclusion has been developed by our members, saying that financial inclusion has two parts. One is about the financial access, so the physical access to financial services. And the other one is the financial health, the well-being of the clients of the retail banks. And that for each one, we are currently developing the KPIs that will help the PRB banks to be able to compare against each other as well. Just, I wanted to end by summarizing what the PRB is by using the IFC's SBN indicators, because I understand that a lot of the participants today are familiar with the SBN. And just to say that, first of all, it is a voluntary principles developed by the banks. It is a global framework aligned to other global standards like the IFC's performance standards or the Equator Principles. And that the alignment to NDCs and national regional targets is the main principle at UNEP-FI's Principles for Responsible Banking. It is that the signatories commit to alignment, that they will undertake impact analysis and target setting to implement these commitments, and that they will set targets on their most significant and positive negative impacts and annually report on the implementation. We do not define what is green products and services. We rely on these for others, like the EU taxonomy or the China Green Bond Catalog, but it really brings these definitions or green taxonomies into the use of the banks in using that will help them to make sure that they are able to manage and create their positive impact. So it is very complementary to these taxonomies. So with that, I want to end my presentation and hope that this has given some idea of what the Principles for Responsible Banking is. And I very much hope that banks and regulators, bank regulators will buy in to these principles, because it really does help to bring all the different parts of the sustainable banking together, but at the same time really drive the contribution that banks are making to the national sustainable development. Thank you. Thank you.
Thank you, Yuki. I'm also happy to see the link between the PRB and SBN. This actually connects everybody together. So that's great. So now I think we can have around 15 to 20 minutes maximum to have Q&A section. And I have already have some question on my list. And once again, if you have any question from the participant, you can just put the question on the chat-in box, and I will pick up some questions to ask our guest. Or if you want to speak by yourself, you can just raise your hand, okay? So I will give you the chance to speak loudly. So according to my list, maybe the first question to Yuan Wei from IFC. So the question is, from your point of view, what are the most important points in developing an effective ESRM guidelines or system for central banks in emerging markets?
Yeah, thanks, Pei-Yuan, and thanks for the question. This is really a good question because if you look at the ESRM guidelines, there are a number of components there. So what are the key things that make some of the guidelines actually effective in terms of moving the bank's behavior, or while some of the guidelines still take some time to really create the push? From last year's analysis by the SBN Global Progress Report, we had an indicator to track if there is any enforcement mechanism. As you have seen from the slide I showed, most central bank has adopted the guideline approach. It's not a policy usually. It's not a very compulsory, like capital type of compulsory requirement, rather as a guideline. Because I mean, fundamentally, this is about risk management, and then banks have their own kind of a risk management appetite and approach. So the one indicator or one component that we have identified as effective in driving behavior change is really the reporting requirement. So meaning once those guidelines are issued, I mean, banks are actually, there are two regulators from China. This is the China Banking and Insurance Commission, and then from Indonesia, OJK. Both have reporting requirements to report back to regulators what banks have done over the past year in terms of meeting those guidelines. Banks are not expected to be 100% there on the first year or the second year, but you need to demonstrate steady improvement over the years. We've seen that has been really useful in both accommodating, recognizing that large banks, smaller banks have different capacity, and they also have a business. They also need to compete in the market, but also gradually based on their own internal risk appetite and capacity, making progress towards the goal. So I would put a kind of a regulatory reporting requirement as a very effective component in effective ESRM guidelines by the regulators.
Great, thanks. I think then I can raise another question to Anthony, because that's about disclosure, climate disclosure. So Wei also mentioned that reporting requirement can be the first step and common step, an important step. And the market will always have concern about the cost. So the question is that financial institution, and I think the listed company as well, may concern about the cost of reporting and disclosure. What do you think about this?
Yeah, thank you very much for that, Pei-Yuan. It's a question we often hear a lot. I think let me tell you a story about a large stock exchange CEO I was speaking with recently, and he was telling me once that when some companies come to his exchange and say, we want to list on your exchange, where we all want to become billionaires and make lots of money with our stock, hooray for us. And he often tells them, he looks at them, he says, be very careful about what you're asking to do. You are now entering a regulated market. And if you cannot afford to have an entire room full of accountants and lawyers, then turn around and walk out the door right now. So let us not pretend that only with the advent of the climate disclosure and sustainability that suddenly companies had costs. So what I'd like to emphasize here is that the relative cost of sustainability reporting is very small compared to the already existing compliance costs of any listed, large listed companies in terms of financial reporting. I mean, imagine they're doing quarterly financial reporting. Every 3 months, you have to update all of these figures for a very large company. Nobody's asking anybody to do quarterly climate reporting. So already the burden is much, much lower. The cost is much, much lower. So we're really thinking about a marginal additional cost for any large listed companies. Now, with that said, this question about cost is a very real question for small companies, for SMEs. And in this area, I think everybody has to be aware also, again, of the parallel with financial reporting, that there are, in the world of financial reporting, differential standards. So you have different standards for SMEs than you have for large companies. So the only people who are going to really have any kind of cost burden when it comes to sustainability reporting or climate disclosure are going to be very small companies. And these are the same companies that would have a burden with financial reporting. And we all have to accommodate that and be realistic about that, of course. And that's where differential standards come in.
All right, thank you. Maybe the same question can go to Yuki. I still remember in our on Monday we have the PRB Principle for Responsible Bank and China Working Group meeting, and one discussion point was about PRB reporting template. So there's quite a lot of discussion on how PRB banks should report according to the principles requirement. And I think this may be new to some participants here. Would you mind to introduce a little bit on this?
Yes. So although this is a voluntary set of principles, we are very much concerned that we want to avoid greenwashing, and that banks sincerely work to implement their commitment to provide impact to society, positive impact to society. So the banks govern themselves to that extent, and Principle 6 of the Principles for Responsible Banking is about accountability and transparency. So when a bank signs up, within the first 18 months, they will have to issue their first Principles for Responsible Banking report. And I showed you the example of the Barclays one. Basically, they don't have to create a new report just for the PRB. They just need to create an annex where they will use the reporting template of the PRB to explain what they have done and refer the main body of the description to the actual sustainability report or this CSR report that you are issuing anyway. And so it will be just an annex at the end. And I think you have a lot of companies are already using annexes. So you are familiar with GRI annex or a CDP report annex or Human Rights Index annex or whatever it is. So PRB would be just an additional annex that you will have. And then thereafter, after the first 18 months, thereafter the reporting will be annual. So what a lot of banks are doing now is for the first one, they might issue a standalone, and then thereafter they will integrate it into their annual report cycling, and that it will be an annex. Yeah.
All right, thanks. I think the message here is quite consistent that reporting and disclosure is important, but not necessarily costly. Depends on how you build on that and how you manage the reporting and disclosure practices. All right, maybe we can have time for another round question, more briefly. First question also to Wayne, that about you showed the case of Bank of Fuzhou about the standard or well the labeling system. So you have the IT system, etc. The question is whether you think each bank will develop their own system or there will be one system for all solution.
Yeah. I think, thank you. That's a good question. I think in the ideal world, it should be one system. I mean, it's a public good thing, right? I mean, it's the same approach, but in reality, this is still at early stage. So we're seeing different banks are developing their own system. So and also in this approach, we also realize that there's a major difference towards this ESG risk management IT system integration between large banks, really large with large balance sheet versus relatively small mid-sized banks. For large banks, they prefer to do just system integration directly into the IT system, credit system. But that's a lot of large investment. You need to kind of open up your existing system to add additional ENS indicators. That's quite of a major update of the existing IT system, a huge investment. For a small and medium-sized bank, like the case I showed, I mean, Bank of Fuzhou, I think it's interesting because it could be relevant for a lot of other commercial markets in other countries. This is a bit of what the IT firm call kind of a standalone system, but connected to the bank's credit system. It's relatively easy to operate and smaller investment cost. So that's a different approach. And then if you talk about, but important thing to emphasize, when it comes to the green labeling, the standards the same in China. It's by the regulators. So the content will be the same. Banks may use different IT solutions, but the banking regulator in China has introduced their own green loan classification system. So it's pretty standardized already.
Okay, thank you. Similar question to Anthony, you emphasize the important and necessity for climate reporting and disclosure. Whether this will be a supplement to the existing disclosure or ESG disclosure system, or expansion of the existing ESG disclosure system, or you believe this will be a whole different disclosure system like TCFD, etc.
Well, thanks for the question, Pei-Wan. I just wanted to share my screen again just to show the answer to that. The short answer is that it is within the existing ESG disclosure area. Climate disclosure already takes place within broad-based ESG frameworks. It's simply about strengthening that climate disclosure. So you can see, for example, this is an excerpt of the TCFD recommendations. And how would you comply with those recommendations? Well, you would use existing indicators and metrics from existing sustainability reporting standards. So if you're already familiar with these types of standards, whether it's CDP or GRI or IRC and so on, you can use these types of reporting frameworks and standards to meet the recommendations of TCFD. So in that sense, it's a kind of a deepening, a strengthening of existing ESG disclosure, but much more focused just on climate.
Okay, thank you. So yeah, it's a deepening of the existing disclosure requirement in the system. All right. For UK, we don't have any question now, but I will give you maybe one final opportunity to make a closing remark or comment if you want.
Yeah, so maybe just to, as a closing remark, just on going back to the opportunity side of so green financing, which China has been, the global leader on. So we, on the one hand, we banks have to worry about risk in environmental and social issues, and they further have to worry about climate, which is about our forward-looking risk, which is, even harder. And then there are these green taxonomies that are happening everywhere. And we are going to definitely see more of the green taxonomy coming up in the Asia Pacific region as well. We have seen China, Malaysia is going to bring out one, and Japan is preparing a transition finance guideline and positive impact financing guidelines as well. So we are going to see a lot of regulators and ministries preparing guidance and regulation around green financing. And I hope that the principles for responsible banking will be a useful framework for all banks to be able to house all these different environmental and social activities, initiatives that they are undertaking within their organization, and systematically be able to tell a story about how they are working towards each one differently, but that together they are creating positive value to the economy, the society, and the environment.
Thank you, Yuki. I think we are just on the right time. So I'm going to close this webinar. So thanks everybody for participating in this webinar, and I hope you can have you can learn some insights and have some takeaways out from this webinar. And please join me to say thank you to our whole 4 great speakers, Dr. Marjin, Yuan Wei, Anthony Miller, and Yuki Yashi. Also on behalf of China Safe, I want to say thank you to our co-host, SBN of IFC, and also Sustainable Stock Exchange Initiative. So I think we are going to close here, and we will offer a replay online later on. Thank you. Bye bye.
Thank you.
Thank you.
Bye.
Goodbye.